Alrighty. So why does this matter? If we think about structuring and negotiating deals, there's real dollars at play. And I always like to use an example of where is this impactful the most. So I'm going to share a Excel. Right. So this is, let me zoom out. Let's see. Okay. Yep, it should be good. So this is a very, when we think about structuring, it's how do we pay for $1 million business? So typically it's in the form of a buyer down payment, seller note, SBA loan, and possibly an investor equity injection if there's an equity gap. So, you as the buyer, where does this fit in? If we look at a $1 million deal and the typical terms of deal one, these are 4 deal options, and then the associated dollar impact. If in deal 1 is a 10-10-80, 10% buyer down payment, 10% seller note, 80% covered by SBA loan. If we look at some various other options, deal 2 has similar terms but a larger seller note. Deal 3 has similar terms but actually a investor equity injection. And deal 4, which is very attractive, is a buyer down payment of 5% and investor equity injection of the other 5%, typically in SBA type deals. And it varies from lender to lender, but best practice is 10% needs to be contributed by the buyer as their down payment. So when we look at the differences in cost, in deal 1, the buyers, the buyer, putting up $100,000. In comparison, in deal 4, when for the same type of business, you can actually only have to put down $50,000. So these are real dollars, and this is for $1 million deal. If we flip over to a $5 million deal, this is where it gets a little crazy. $5 million. If we focus on deal 1 and deal 4, this is when real dollars are at play and why all of this matters. The buyer down payment in deal 1, which is a very traditional structure, $500,000 of cash that's needed to be eligible for this loan. If you were to structure it creatively with an investor equity covering the other half, you're actually able to get the same loan size for half, $250,000 less. These are the nuances of deal structuring, which hopefully we can cover a little bit today through real examples of ways you can put less down and still meet those SBA requirements, whether it's a larger seller note, outside, investor equity injections, etc. So I did want to just highlight these. It does show a pretty cool example. Pull back up the slides. So the importance of deal structuring in SMB type acquisitions is critical. The being able to successfully explore creative deal making is a win-win, and it really maximizes your potential in order to finance creatively. And hopefully in this session, we can cover some of those high-level topics. A well-structured deal minimizes legal, financial, and operational risk for both parties. If you think about businesses, if you're overpaying for a deal, that not only is financially risky to you yourself as a buyer, um, it's also risky for the business itself. A lot of these small businesses have um, dozens of employees with families, and businesses that are overpaid or structured poorly ultimately could close, which has another set of scenarios and circumstances. So it's really important to get this right ahead of time to really set yourself up in your deal for success. See if I can pull this up. There we go. All right. So here are some of the deal structures we covered in that example. Um, Buyer down payment is typically 10% of the total purchase price. Other creative deal structuring you can leverage is seller earnouts. Earnouts, these are non-SBA type loans. Typically, in a seller earnout, you can tie a portion of the total enterprise value of the deal based on performance milestones. Yeah. I am certainly not an SBA lender, but as of today, I believe these are still not allowed. So, how do you get there? The SBA does allow a seller note or um, seller financing, as it's called in industry, to reduce the upfront capital requirements as a buyer. Um, a new item is the SBA actually allows equity rollovers, so the seller can retain partial ownership. Uh, so you could have partial buyouts if you want to buy 80% of the company, and the seller can retain 20. There are certain SBA thresholds and nuances, so definitely speak to one of your SBA lenders. I have a few who I'm happy to make introductions for, so we can double click on those nuances before you submit that LOI and get started in due diligence. Speaking of due diligence, this is a high-level overview of really the timeline of the pre-LOI, LOI, and the business purchase timeline. You'll see on the left the pre-LOI procedures. This is really your search phase. This is when you're searching for businesses, having those discussions, and things like reviewing SIMs, preliminary discussions with sellers, LOI drafting, even putting together agreements and deal structuring like this. From there, once you do get that signed LOI, this is when it really starts to kick off. So in a signed LOI, typically it'll be anywhere from 30, 60, or 90 days. I always recommend a 90-day LOI to give you ample time to conduct due diligence and negotiate certain elements such as working capital, because those are really important deal items, and they take time. Think about these business owners, they're running day-to-day of a small business. They have to answer to employees, and their number one priority should be continuing the business going forward. So give yourself ample time. It's always frustrating when I see LOI or exclusivity periods for 30 days. This is not setting yourself up for success. I've done deals in 30 days, but it is a full-time effort by the sellers and the buyer. And more often than not, it's just rushed. So do yourself a favor, give yourself plenty of time to get these deals done the right way. So best practice is 90 days. From there, you will conduct financial diligence, SBA underwriting, other areas, and getting to that final closing document section. So I always like to say, you have your phones out or take a snippet of this as your kind of timeline chart where you can go back and reference if you do happen to get a business under LOI. It's very helpful to see a high level. What are the steps you need to do to actually get this thing closed? This slide is another kind of step-by-step of what it looks like to get deals closed. Again, you have that initial contact and preliminary terms. This is going to be the primary focus today. Getting those term sheets from lenders or bankers, etc. So our first example is a $6.75 million landscaping company. So this landscaping company this is directly from the LOI. So this gives you a good idea of a real deal in terms of how they thought about structuring. So let's think, if we flip back to our original example, how do we structure deals? It's going to be in the form of a portion for the buyer as a down payment. There may be a seller note, and there may be other things kind of involved to get to that total purchase price. So if we look at this specifically, it says $10,000 will be delivered to the seller upon delivery of this LOI. So that's typically called an escrow. At closing, the company will capitalize $750,000 in the form of a seller note. And then at closing, the buyer will deliver to the seller $6 million in addition to the deposit and the note. So doing quick math, the seller note is approximately $750,000 over the 750. It's about an 11% seller note. So if we go back to the example, typically it's a 10-10-80 split, 10% down payment by the buyer. In this case is 11%, and then the buyers deliver, and then the SBA loan and an additional loan, because it's slightly above the threshold, is going to be needed to actually pay for this business and deliver that $6 million to the seller at the time of close. So when we think about deals, it's often best to think about the big picture. We think about, why do I need the SBA loan or any kind of traditional loan? It's really to deliver this cash at close to the seller. You're not going to put up $6 million of your own money. So that's kind of where we take concepts and we put them into reality of what they look like in LOIs. Obviously, LOIs should be crafted by M&A attorneys who do this for a living, but this is a good high-level visual of what it takes. Let's keep it moving. This is a $3.6 million enterprise sales company. If we look at the terms, it's a $3.6 million total purchase price. $3.2 million is paid to the seller in cash at the time of closing. $200,000 is pursuant to a take-back by the seller as set forth in seller financing. $200,000 is deferred compensation, which is expected to be awarded to key employees. Now, this is a non-SBA loan, as an FYI. The reason I called that out is because the seller financing is actually structured as an earnout. So it is tied, the $200,000, which is less than 10% of the total purchase price, is tied to future revenue performance. The buyer I worked with who structured this agreement wanted key employees, which were 3 of them, to be incentivized to stay when he assumed duties. And he wanted the seller to be incentivized to answer his phone calls and keep the business running. So he tied a portion of the proceeds to the seller financing note, and he gave deferred consideration to key employees to keep the company thriving going forward. Next one is a $8 million manufacturing company. What are the terms? So we go back to my comment on partial buyout. In this case, if we double click, the buyer is actually purchasing 85% of the business. So that in his view, the enterprise value was $8 million. For $6.8 million, he wants to buy 85% of the company. So the seller, going forward, will retain the other 15%. This is another way you can structure deals. And for buyers who want to go after larger businesses with more larger EBITDAs and a bigger pie, this could be a structure I recommend. If we look at the cash at closing, 6.1 million. And the remainder is going to be 700,000, which is in the form of a seller note at a 10-year term and a simple interest rate of 7%. I get questions often, so I wanted to call out this one. The promissory note will accrue interest but not have payments for the first 24 months. This is a common 2-year standby. So for the first 2 years, the seller is basically loaning you out $700,000. You are not, it will accrue interest, but you don't have to make payments on it. This is best practice in my opinion, because it gives you wiggle room as you assume duties that you don't have to be burdening the business with monthly interest payments to the monthly note payments to the seller each month in those first 24 months. So after 2 years, hopefully the business is performing well enough, when even better than at the time you assume duties, so you can start making those payments on the seller note in that 25th month. So that's how kind of those structures work. The other thing that's helpful to call out is this agreement says, and I'll try to move my face out of the way. This agreement mentions the purchase price assumes an adjusted EBITDA of at least 1.35 million for the last 12 months. And a working capital figure, which is to be agreed upon by the buyer and seller during the due diligence period. This is where a due diligence provider like myself steps in. Essentially, the seller and buyer in this scenario have agreed to loose terms of, if the adjusted EBITDA, which is going to be performed by my third-party due diligence provider, if it's short of 1.3 million, we may need to renegotiate these terms. This offer was submitted based on the assumption that EBITDA was roughly 1.3 million. So if after due diligence is finished, it turns out that it's actually only $1 million, it materially impacts the valuation. So adding in language like this is often helpful because A, it sets the standard for, I'm submitting a bid based on the financial data you provided, but I have not actually verified it. I have done my own due diligence, which every buyer should do, regardless of if you want to bring a deal team in or not. But ultimately, you're not a trained expert, or if you're not a trained expert, there are certain things diligence providers can do to double click on EBITDA to better assess that it's real, it's normalized, and can be expected going forward. While historical financial data is how the SBA makes loans, um, you as a buyer need to know, what does the go forward profitability look like? That's where a diligence provider steps in and can add tons of value. Obviously, the working capital figure, in this case, he didn't set a certain dollar amount. He had one in mind, but for purposes of structuring the LOI, he didn't want to be held to a certain dollar amount if it was higher or lower after the diligence provider assessed working capital appropriately. Um, in this instance, his assessment was actually working capital should be around $500,000. After my working capital analysis, I actually determined it was closer to 850 or 900. So it was beneficial. He actually didn't state a specific number, because if he did, we may have had a more challenging time negotiating this working capital number, which is around $850,000 compared to 500, which he originally guessed it was. Fortunately, this business did have an EBITDA, adjusted EBITDA, in my opinion, of about 1.3 million. So it checked the boxes and he was able to actually successfully purchase his business. So again, in my opinion, the best way to learn is to analyze actual real deals and not focus on concepts. So this is just another way how you structure a deal for a partial buyout, in this case, a majority buyout of 85%. And then what other language do you put in to set yourself up for success? So creating a deal structure to bridge a valuation gap. In this case, a buyer and seller disagreed on the valuation of a manufacturing company. To bridge the gap of 1 million, they implemented an earnout structure. The seller would receive an additional 1 million if revenue targets were met within 24 months. Again, earnout, think non-SBA loans. These are traditional loans. The benefits of earnouts are, it can align incentives. So if in this instance, the business purchase price was $15 million, he tied 1 million of the 15, so under 10%, to revenue targets, which had to be meet or exceed the prior period, so the trailing 12 months. If they did not, the seller would not be subject to this $1 million. So it incentivizes the seller, who's going to stay on as a consultant, to continue to work hard. I mean, he has $1 million at play. Whether or not the business purchase is 100 million, 10 million, 1 million, if you give them in real dollars, they will get to work. So I think this is earnouts are very popular, especially in middle market deals. So I wanted to call that out. So this is a sources and uses table. A common misconception is what types of, what are the actual dollars like I need to disperse at the time of closing? Things like SBA loan fees, guarantee fees, these are things that get overlooked when people think about a $5 million loan. So typically, it's about a 3.5% of the total loan is actually going to be added on in the terms of fees, closing costs, etc. You'll see that for this $5 million loan, 175,000 is the SBA guarantee fee, and then there's closing costs of 25,000. When you think about deal structuring, it's often helpful to put together a sample sources and uses table to see the actual dollars you'll need to disperse. If we go back to the first slide, the SBA requires a 10% down payment of the total project cost. If we look at just the total sources of funds, the 5.7 million, if that was the total project cost, the buyer would need to actually cover 570,000. More often than not, some of the buyers I work with, their expectation is I need 10% down of a 5 million loan. They don't take into consideration the fees and the SBA closing costs. And then there's sometimes that equity gap. Equity gaps can be hundreds of $50,000, $25,000, or $100,000 typically. But that's real money you as a buyer might not have. So putting together the sample sources and uses table is super helpful early on in your deal to understand, hey, how am I going to actually fund and meet these requirements going forward? This is a 4-scenario chart. We kind of covered this, so I'm going to skip this slide. This gives you another idea of, how people can put down various scenarios. In today's market, things like 50% seller financing, 30% seller financing, those are going to be very challenging to convince a seller for a business that's not struggling. So keep that in mind. There are a lot of comments about, putting $0 down and getting 100% seller financing. That's just not realistic. I've done hundreds of deals, and I have only seen a handful of purely 100% financing deals of the seller. Those were all for distressed businesses. Any profitable business owned by a small to medium-sized business owner is not going to give you 100% seller financing and just hand you their business. So keep that in mind as you navigate this kind of crazy world of SMB deals. So ultimately, you want to craft an offer that works for both parties. Deals that are closed, really, they need to be, you need to ask the seller, like, what do they want? They want to continue their legacy. Is it just the dollars at play? Really thinking about what motivates them. Because ultimately, you could put together the best deal in your terms that pencils, it's able to get a loan on. But if it's missing something the seller wants, they're not going to accept it. And if they have reservations and they sign the LOI, very likely those concerns are going to get real as you get to the closing table. So keeping those things in mind is super important. More financing options. Obviously, if you do SBA banks, the threshold right now is $5 million. If you want a $5 million loan, they'd be happy to give it to you. If you want something larger, there are various options to have traditional. So these are some of the things to think about. Obviously, if you want a traditional bank loan, you'll have to work with your lenders in order to finance those deals. Choosing the right financing option really depends on the deal's size, scope, and the growth potential, and whether you're going to do an SBA or a traditional loan. So when we think about negotiating strategies, things you're going to more often than not actually negotiate in these deals is things like working capital, seller notes, and if there's an earnout in place, those are going to be the big ticket items. Assuming you get the EBITDA numbers verified through due diligence and everything checks out, that's where you will do the primary bulk of your negotiation. If the business needs a certain level of working capital, bringing in a third party can be super beneficial, and can be a real value driver as you navigate these deals. These are a couple common pitfalls. You need to focus on the terms of the price. What does the total purchase price look like? And more importantly, how are you going to pay for it? So think sources and uses table. Um, um, yeah, so think sources and uses table. Poor communication, keep all the stakeholders involved and really keep them informed throughout the process. More often than not, a lot of these deals will die due to lack of communication. Sellers may get skittish about what's happening with the deal. So keeping them continuously involved is super important. This was another example. In the essence of time, I'm going to skip it about leveraging seller financing. You'll notice the seller agreed to a 50% financing of a small deal, 500,000. All these slides will be available at the end, so no worries at all. And that really concludes kind of thinking about negotiations. If we go back to the original slide that we started with, thinking about these structurings is super important. These are real dollars at play. Understanding the buyer note, the seller note, what portion of the SBA loan you're going to use, and if you're going to have an equity injection. Putting together a table like this, I did it in Microsoft Excel in about 5 minutes, can be a great visual of understanding where are the dollars coming from to actually buy a $1 million business, 5 million, and what are various ways I can better bang for your buck. If you're able to get outside investors, you can potentially put less down, think 5%, not 0%, maybe 5% of the 10% requirement. So thinking high level as you talk to these sellers is super important.